right, it is that time in which we will now bring in tech trader Sean Udell. Merry New Year to you, buddy.
Hey, how you doing?
I'm doing well. How was the little hiatus that you had?
Well, I didn't have the hiatus that you had, but no, everything's good. I mean, this is probably the most relaxing mini market crash that I've personally ever had.
Yeah, well, why don't we dive right into that? I'm sure by now you've digested the Apple news and what they had to say and how it reflects some of the stocks that you cover. So what's your takeaway in all this?
Well, I mean, you and I have talked about Apple a lot. I've written a lot about Apple. I think the last time, around the time I first joined Briefing, is probably about the only time I've actually been really bullish on Apple in my time here. Years ago, I mean, I jokingly say I was the biggest bull. I was the biggest bull in Apple on the planet in 2013. I was writing, working for some other people then, doing my own thing. I had a price target, I think at the time, that was like 2.5x the value of Apple when it was a $400 stock. And then again, this is all split adjusted, but Apple was an incredibly cheap stock at $400 in 2013. It had come off, I think, 762 in 2012. And at the time, the average analyst price target was, I don't even remember what it was, but it was maybe 40% higher, and I was 250% or 150% higher, or 250% higher. And that all basically fulfilled. And there's lots of times when people can just completely miss things in tech. And so not to pat myself on the back too hard enough that I pulled my shoulder out of socket here. But I mean, what have I basically said since January, or even before then? That look, Apple's not that attractive, FANG's not that attractive, NVIDIA's not that attractive. In fact, these stocks are incredibly dangerous. And so what we saw in slow motion kind of over the course of the year was that those stocks kind of led all the corrections down. And then what we've seen in fast motion, and it's, I mean, your vacation, like you missed the kind of the 14 craziest days I think we've seen in the market since 2016, and not saying you weren't personally looking, but you were on your official vacation, and now we're seeing it in fast time, in real time, right? So the question I think is what when do we overshoot? But I'll say this. Hey, I was so firm on this, and I've written this hundreds of times that I don't like FANG, don't like Apple. When the stock was 80 points higher, and so the question now is there a price, or is there a time where I get bullish on Apple again? And again, the last time I was super bullish on Apple on Briefing was when the stock was between 92 and 95, and that was right around the time I first joined Briefing. I think it was around the time when the elections happened and stuff like that. And honestly, now I still don't like Apple. I really don't. My central point, and the point that all the media hounds and all the analysts and pretty much everybody misses, is one super huge critical thing. What would Apple have done had they spent $150 billion on strategic M&A versus stock buyback? How much cash flow, additional annual cash flow per year would they be producing? So let's even say they overpaid for stuff. Like they bought good stuff but overpaid for it. They would have still probably bought $20 or $30 billion a year in annual cash flow. That Apple would be far more valuable had they done that instead of buying stock back. So you kind of like all the things all the chickens are coming home to roost on Apple. And I don't mean to pile on Apple, but again, I've said all this before. I mean, I have said everything I'm going to say. I've said all this before, but the chickens are coming home to roost. And so, okay, they bought back stock and then instead doing M&A. That's the biggest problem. Second problem is, I'm not as critical of this, but you could make an argument they haven't been as innovative. Again, there's a lot of innovation in the core. There's tons of innovation in the software. There's a ton of innovation in the efficiency of the software and how little the footprint of iOS and Mac software takes. And I could go on and on and on and get really wonky about the technology advantages of Apple, and there are a lot of them. But innovation does look a little light. I mean, basically the company's kind of done a mini playbook of what really was kind of the doom playbook for IBM and HP and Compaq and many huge stars of technology, which they bought stock back instead of doing M&A. And so the counter to that is, well, what if you do really bad M&A, like HP did buying, God, what was that company? It just escaped me. They bought it, basically paid, $20 billion or $10 billion for a company that effectively was fraudulent. Okay, well, Apple doesn't do that. I mean, the beauty of Apple's M&A is when they do M&A, it's actually pretty darn good. They just don't do nearly enough of it. So without spending too much time on this, where's Apple an overshoot? I used to think it might go to 125. I actually don't think it will now, because I think too many people are kind of looking at that price. I think it's an easy price. It's basically cutting the stock in half. It's still one of the best cash flow producing entities on the planet. Still has a very good balance sheet. They do have to start doing M&A. I mean, at some point they have to do M&A instead of buying the stock back, especially when the stock price is high. But I don't know. I think 130, 135 is the floor. I think it's pretty close to the floor. But I'm not going to be interested in Apple until for probably another 6 to 9 months. I'll land it there. You can ask me whatever you want, but basically, if beyond that, I'm kind of beating a dead horse.
All right, so what about...
By the way, there are very good reasons for my time frame, if you want to ask me about that, but it's all up to you.
Well, I do, and mostly how it relates to some of the tangent plays that you've talked about, the 5G plays in particular, because they're, let's face it, associated with Apple. They're joined pretty closely. So why the delay in Apple as opposed to some of the other ones, and has anything happened that would change your view on some of the 5G plays that you've been touting for a while?
No, in fact, I think the case for 5G is even stronger, and there's two reasons the case for 5G is stronger. One is 5G is not dependent on Apple, but Apple will be a good 5G play. I'm leading the horse a little bit. So, but 5G is everybody. 5G is everything. 5G, again, I don't know if you want to talk about this, but I really do think the sell-off we just had is much more akin to 1998 than any other period of time I can think about. I think the other period that would be closest would be 2011, but 2011 was part of financial crisis kind of look back sell-off, and we're not having a financial crisis right now. So, but anyway, the rounding this off. Okay, so 5G is still early. 5G, we will see a lot more traction from 5G in 6 months than 6 weeks. But 5G started kind of getting mentioned in companies' reports the last quarter of last year. There was one company, I can't remember the name of it right now, but they actually said their 5G growth was something like 200%. Well, that probably wasn't hard, because in the quarter before, maybe 5G was $100,000, and then it became $1 million, right? Well, that would be a 10x. So anyway, the bottom line is, if you're starting from a really low base, you can have really exceptional 5G growth if you basically had very little 5G sales before, right? But the 5G is now coming into cycle, and so here's the question. Does Apple actually have a 5G problem? I think they do, because they had a large screen device problem. So why I was able to buy Apple so cheap in 2013 was because they waited 1 more year to make large screen devices. They should have started making large screen devices on the launch in, I guess, the 2013 cycle. They didn't. They waited another year. Now that created an unbelievable opportunity to buy Apple, because they literally missed like 12 to 18 months of large screen device sales that they should have had. They literally gave the large screen device market, they completely gave that market away to Android. And then that ended up being sort of peak HTC, peak Motorola, arguably even peak Samsung. So it was peak Android, right? So Apple they basically allowed peak Android to occur. But, you know, that's still a ton of devices. That's still a lot of revenues that the Apple's never going to see again. I think they're actually going to make the same mistake in 5G. I don't think they're going to have a 5G phone. All my work I've done on them, I don't think they're going to have a 5G phone. They're definitely not going to have a suite of 5G phones this fall. Do they even have one 5G phone? I don't know. If they don't have one 5G phone, then you basically got to say, okay, so then you have to time it. You have to say, okay, so Apple's basically giving all the early 5G phone sales to Android. So when does maximum pain occur? And then that's kind of why I'm saying 6 to 9 months. Because I think if they don't have a 5G phone, you might have one further kind of puke in the stock, but it might not really be a puke. It might just be sort of a retest of what we're seeing kind of now. I really don't think Apple's going to trade much below 130. There's all sorts of valuation reasons why, but yeah, 130, maybe even today, maybe even. I mean, it's low enough. It doesn't have to trade. I mean, you back out cash, and it's probably trading at a PE of like 7 or something again. I think, by the way, when I was buying the stock ex cash, I think the PE was 4.7 in 2013. Apple was literally trading at 4 times net cash. That's extraordinary. I mean, if you. I think I'd have to go back. The only ever time I personally bought Apple cheaper was when I bought Apple at $12.50 a share, I bought it for $16.50 a share, and they had $12 a share in cash, and that was like in 2003 or something like that. So I have a very long history with Apple. But yeah, if they completely miss 5G, then guess what? The next 18 months is sort of it's kind of a big Android party again. And they're going to miss a lot of sales that they could have had. And then, you know, other people talk about things like, well, the phones are too high priced and they don't have innovation. And I don't know. I mean, yeah, there's probably some arguments to that. But I mean, they missed the central point, you know. And the central point is Apple's spent way too much money buying back stock instead of doing M&A. And secondly, they've violated U.S. contract law by not paying Qualcomm what they agreed to pay them. That's really dumb. And if they miss 5G for a year, that's going to be really dumb. So, and again, you know, no insult to people here, but you know, if you're paying $225 or $200 or $195 for Apple, that was really dumb. So, you know, we'll see what happens. But you know, if people would just quit buying. By the way, if people would just quit buying FANG, the market would already bottom. The biggest reason why the market hasn't bottomed is people keep trying to buy the FANG stocks. So as long as people keep trying to buy the FANG stocks, they pump up 10%, and then they deliver bad news, and they cause another market sell-off. I mean, it's really kind of funny. And that's another story. But yeah, I really think 6 to 9 months will probably be a really exceptional time to get long Apple. And it could be a little longer than that, by the way, because I thought the same thing back in 2012. I kind of timed this thing exactly the same back then. I'm like, okay, if they missed large screen device sales, probably sort of the fall, if they don't have a large screen device in the fall of 2012, the stock will be really attractive. Well, it went from like 760 to 500, but I didn't quite feel it had bottomed yet. And so it took until the March quarter, or March, I think, of 2013, when Apple hit $400. And I'm like, okay, it's almost cut in half, not quite, almost cut in half. That's when I stepped in huge to Apple back then. And so I don't know. We'll see. I mean, I'm still thinking right now that it could be around the time the next launch. It could be a little later. It could be, or I might just decide, you know, there's so many better opportunities. I'm just going to wait on Apple a little longer, and then if it happens to become cheaper, it becomes cheaper. So we'll see. But I don't know. It doesn't look like they're really. I think they're going to kind of poo-poo the whole 5G thing. I think they're going to say, oh, 5G technology is not great, just like they said, oh, they poo-pooed large screen devices. And, you know, they missed again. They missed 12 to 18 months of sales, a lot of large screen device sales that they arguably should have had. Because when everybody was saying Android had all this innovation, it didn't really have innovation because making a phone bigger is not innovative. But that was the key innovation of Android. They just made really large screen phones. Apple didn't. They basically ceded that large screen device market to Android, and then they ended up grabbing it back later, right? So I guess the interesting thing could be, will there ever be a time when Apple, I guess, messes up bad enough that they lose market share that they can't grab back? I don't know if I see that yet, but you know, I guess if you want to be really worried about Apple, that would probably be the thing to worry about. But as far, by the way, I'm just going to lead you on this. So as far as Skyworks, as far as Qualcomm, as far as Micron, I think this is a golden opportunity to buy Apple suppliers. That would include LITE. That would include IIVI. LITE is the one I'm probably the most cautious on of them all. But yeah, Micron, Skyworks, IIVI, maybe even a Cirrus. Cirrus is a huge. I mean, they're like a 75-80% customer of Apple. But yeah, by the way, Cirrus isn't acting that bad today. And we could kind of talk about the food chain, but you know, the other thing too, I'm going to say this, I'm probably the least surprised person in the world that Apple guided down. Because what have we seen? We saw a huge guide down from Micron, huge guide down from Cirrus, big guide down from LITE. I think LITE's half market share loss, half Apple. We saw a big guide down. I mean, the Skyworks guide down was like 8%. Didn't Apple just guide down by 8%? I think they did. In fact, I think Apple guided down by 7.9%. So this is like probably the only surprising thing is, how did Apple not see this when they reported earnings? That would probably be the only surprise.
I wonder how much this had to do with the China talks that are about to resume. This was one of the comments that one of our colleagues here, Event Trader, had mentioned, and I wonder if there's some timing involved from Apple, just to I don't know, to kind of play that card in front of the those discussions. Oh,
as a lever.
Yep.
As a lever.
Yep.
It could be. I mean, I think companies typically kind of have to report with the numbers they see, right? And I think that.
Well, that's what they're seeing now, and they can say it now. I mean.
Yes, that's true. Now, and by the way, though, I don't think they're kind of fibbing about any of that. I bet China sales do suck. You know, I mean, I bet a lot of Chinese buyers are like, you know what, screw it. I'm going to buy a $199 Xiaomi phone, if it's even that expensive, than the Apple phone. And I'm going to buy a $200 Huawei phone instead of the Apple phone. And by the way, the Huawei phone I'm buying probably has a 5G modem in it. If it doesn't have a 5G modem now, it will, right? So. I do think there are phones, by the way, with 5G. This is something I don't know 100%, but I think there are actually 5G-enabled phones already selling in the Android space. And China's going to light up 5G pretty soon. See, that's part of the other issue. You know, so is Apple going to cede all of China 5G sales for another 18 months? To Android makers? I guess they might. So anyway, but yeah, no, I think China sales probably are poor over there for them. I don't know how much it has to do with with the China, you know, the mini trade war we have. I just think it's like they're trying to sell really expensive products into a Chinese economy that is getting worse. And so as economic conditions are getting worse in China, what's the natural occurrence? The natural occurrence is those people are probably not going to spend as much for items as they maybe would have otherwise.
All right, so why don't we talk about which one is your actual favorite? Cirrus, Skyworks, Micron, IIVI, run through.
You know, I don't know if I'd have a favorite, but my Skyworks is very interesting now because it's actually today it's setting a new low today. You know, I started kind of thinking about this stock. Probably where was the November 20 low? Here, I'm going to pull it up right now. It looks like the November 20 low was around 68, 69-ish, something like that. Mm-hmm. I didn't buy it there. Put it this way though. That's when I started saying, okay, this is definitely long radar. I'm watching Skyworks now. And, you know, just as a reminder, you know, people that were really bullish on Skyworks, you know, somebody could have paid $117 for Skyworks as early as spring of 2015. So imagine doing that. Now, again, Skyworks was mid-50s at the 2016 lows. but it never really broke. It didn't. I mean, I guess it technically did, but it really never really broke that spring of 2015 high. I think that's a pretty good mark, by the way. I think if you're buying Skyworks here, or lower, or in the next 3 months, whatever, I think you could basically kind of say, yeah, it has a good shot at hitting that 2015 high. So Skyworks would be, if I were to rank 5G semiconductor plays, it would probably be my third stock, my third in rank order. Qualcomm number 1, MTSI would probably be number 2. MTSI has a very good 5G portfolio. A lot of people probably don't realize that. They actually do. So Skyworks would probably be number 3 in my 5G semiconductor portfolio. So again, you know, if you can believe that you can hold through the abyss, either is now the abyss, or does Skyworks have another 10-20% lower? I don't think any of us know exactly. This could be a low. I mean, again, anything close to those 2016 lows, because those were crazy lows. But yeah, I mean, if you can basically hold Skyworks through the abyss, you know, all you have to do is catch the first quarter where they basically say, yeah, 5G sales were huge, and the stock's probably $70-$80, if not more. And then you have roughly an 18-month to a 24-month, maybe even a 3-year cycle. 5G, the cycle for 5G, I think, is largely misunderstood. I think most people think, yeah, it's going to be a 4 or 6 quarter cycle, like 4G was. I actually don't. I think the 5G cycle is going to be very elongated versus 4G. So yeah, you know, you got. I mean, put it this way: what if Apple doesn't have any 5G devices until 2020? So you're going to have Skyworks with very good 5G revenues all the way through from 2019 to 2020, and then Apple's going to have 5G sales. And again, you're going to have a monster refresh rate from 2020 through to 2022. So you're going to have huge 5G device sales, you know, RF micro and antenna sales and all that stuff from Apple. So from 2020 to 2022. So yeah, it's pretty easy to pencil out, you know, 1919 to 2022. That's a 36-month 5G cycle. So at some point, I'm gonna get pretty aggressive on Skyworks. I don't own a single share of it yet, but I'll own some. You know, sometimes you kind of have to, you know, it's kind of like you're trading, you know, you're trading wishes, because okay, you already have. You know, like I could say, hey, I really like Qualcomm. So, and then I could say, oh, I really like MTSI. Well, at some point you kind of say, well, do I need 5, 6, 7, 8 5G names, or do I, you know, is owning 2 or 3 of them good enough? So, you know, that's probably what the world will be facing at some point, is like, okay, how many 5G names do you kind of need? And the typical person will wait till these names are 100, 150, 200% higher, and then they'll buy every 5G name on the planet. Well, you know, maybe everything's been priced in by that point. So, you know, it's like anything else in tech. You usually have to anticipate, you have to position, then you have to wait for the catalyst, then you have to get paid. And, you know, if you wait too long, it's hard to get paid. So, you know, 5G, though, will have a pretty long cycle. But you know, I'd much rather buy Skyworks at 60 than 90. That's just me. But it's still probably would be a pretty good buy at 90, because it's probably going to blow. It's probably going to blow through that $117 high of 2017.
All right. So I don't think I caught it. So Skyworks is your number 3 5G play. Is Qualcomm number 1 and MTSI number 2?
Number 1. Yep. That's it.
Okay. All right. Just noting that Qualcomm number 1, MTSI number 2. All right, well, let's look at MTSI, because I know this is one that you've been involved in for quite some time, and it's trading not too far off the lows. Are you thinking about dabbling in this one anymore?
You know, I've probably got enough. Yeah, I could buy more of it, but I've probably got enough. I would probably need. I don't know. You know, I mean, that's the one thing I've always been pretty good at doing. You know, it's good to have a lot of something that goes up a lot, but it's also good to kind of know when enough is enough. Mm-hmm. And here's the issue right now. I mean, I could rattle off 20 names that are just as attractive as MTSI. I'll name one. I don't even have much of this yet, but something like a CommScope. So CommScope is another tertiary 5G play, but really what CommScope is just a really, really solid company in kind of the bandwidth infrastructure space at doing what they do, but they're a cyclical company. So again, everybody loved CommScope between 35 and 42. This was a company recently re-IPO'd after a private equity acquisition, and they were doing fine. And their misses haven't been that atrocious, but I don't know. I don't know if it's the miss or the buy of Eris. They also bought Eris, which is a very solid, long-term kind of solid tech provider. But you know, CommScope is 17. Again, if it, you know, this was not an expensive stock at their highs. And you know, the highs for 42. I mean, that's something like 3 times what the stock is now. So you know, I mean, I guess the biggest problem I have with buying more MTSI is, you know, I can look at CommScope and then I can multiply CommScope by a lot of names. I mean, a lot of names. And so, you know, I'd rather kind of have juice available to kind of spread my bet and catch a lot of things. You know, I mean, whether it's all the beaten IPOs, whether it's stuff I named in my January effect list, whether it's Apple suppliers that are getting tortured. I mean, there's just, we probably hit the space, by the way, where the ticker doesn't matter. I mean, you know, as long as you're buying quality, as long as you're not buying, you know, as long as you're not buying overvalued cloud. There's still a lot of overvalued cloud, by the way. But anyways, you know, as long as you're buying quality, good balance sheet, something that has a turnaround growth trajectory, or just still has good growth, you know, you probably got a very good shot at really, really profitable positions from here, from current prices. So at some point, the ticker will matter again. It will matter probably whenever we kind of hit the next interim market high. Which nobody's even thinking about right now, but we'll have one. I don't know if we'll have one in 6 weeks or 3 months or a couple quarters, but you know, we'll have an interim market high that'll probably be a lot higher than stock prices are today. And then the ticker is going to matter a lot more. I mean, even something like a Netflix, which I haven't liked, and I said this was a totally disaster stock in the making. Okay, well, they cut it in half. You know, I'm not short. I wouldn't be short Netflix now. Yeah, and it's a lot, you know, it's a lot more attractive at half price than it was, you know, at the ridiculous kind of bubble high. I still don't really like this name, but again, you know, if the market decides to bounce here, Netflix probably has quite a few points of upside before it's a good short again. So, but yeah, no, I like MTSI a lot, but I think that, you know, it's part of my larger kind of fiber optic field bet, and you know, we'll see what happens. The kicker, though, and the reason I've always liked MTSI is because they do, I don't know what percentage of sales I guess would be classified as 5G, but again, they're in the antenna game, they're in the chip game, you know, they're in several pieces of that sort of that 5G space. And it's entirely possible, you know, a lot of people ask that, like, well, they don't understand why the stock has traded the way it's traded. You know, why it went from such a great high. Well, there could be a case where, you know, because China kept investing in 4G technology pretty late. They were globally very late. So they were late to 4G. They're going to be early to 5G. But MTSI was still getting pretty good 4G sales, probably way past most other companies were. That might have something to do with why the stock had pretty good results all the way into sort of late 16, early 17, before they kind of fell into a mid. And by the way, it's not like the results are terrible. I mean, you got the stock is like roughly 66% below where the stock price closed at the end of 2015. Yet their revenues are notably higher than where they closed 2015 revenues. So this is just one of my favorite fundamental situations where I think that people kind of completely lose their mind and they forget the fundamentals. And, you know, it wouldn't be a big stretch to have MTSI, you know, get back to kind of all-time record revenue production again. And, you know, still have the stock be way off all-time highs. So, and this was almost like a late momentum play that kind of burned everybody or burned all the late buyers. But yeah, no, this is a good 5G play. I like it. It's also a fiber optics play. I mean, they're like a lot of chip companies that they do a lot of different things. They're also a defense play. I don't know if defense business has really been bad for them, but it's probably been kind of neutral. So it hasn't been a big kicker. I think defense was a big kicker, a couple years ago. Probably post-Trump victory. I think defense probably had a really good kind of 4 to 6 quarter move. Anyway, not to spend too much time on them, but yeah, they're very, very attractive name on valuation. So, I don't know. We'll see. I kind of make my buy decisions when I do them. Right now, there's just so many good choices. I'd rather increase the number of names than decrease the number of names right now.
You mentioned earlier that you were somewhat cautious on LITE, L-I-T-E. Where does your caution come in? How big are you, and is that one that you may bail on?
Well, no, I don't have LITE. In fact,
you don't have any LITE on
I haven't
currently?
No, I haven't had any LITE since I traded it off of a big downward kind of move. It had a good short-term spike up. That was probably back like late summer, early fall. Was probably the last time. My caution in LITE is probably pretty simple. It's that their last warning, they didn't attribute any of the warning to market share loss. It was all kind of, I guess, iPhone, poor iPhone sales, which now kind of looks right on, but I still don't. And sometimes companies just do this. Sometimes companies don't really see the field as well as other people because they see the trees, they don't see the forest. And I still think part of what they're seeing or dealing with is some early market share loss. So the problem is if LITE hasn't had any kind of quote unquote effective market share loss, they're still going to, because IIVI, the combination of IIVI and Finisar, is definitely going to gain share against LITE. So, but again, it's this. Is it priced in at 39? It's probably pretty close to priced in. But it might not be fun. I mean, I like LITE. I mean, I really like it. Let's say if I didn't have any of these other names, and I didn't know that much about fiber optics, it would look like a really good company to me. But kind of knowing what I know about the space, it's an attractive company in their space. I just kind of worry if there's one more. What if there's kind of one more? Oh crap! Now we have to deal with a market share loss on top of sort of slow iPhone sales. I almost kind of worry if there isn't one more warning. Maybe I worry about. Where, by the way, everybody else is probably saying. And then there is one thing. I mean, I think the briefing platform is full of just a ton of super good information by all the contributors. One thing I would take issue with, I don't know who said it, and maybe it was a group of guys who said it, was like, oh, I think this Apple pre-announce might usher in like a ton of pre-announcements. You might see a ton of companies pre-announce. I don't know if I agree with that. We could talk about that later too, but I just don't know if I agree with that. For example, I'm not so sure. I mean, I kind of think Micron, I think they've kind of cleared the decks and threw the kitchen sink out there. I think Skyworks cleared the deck pretty good. I'll remind everybody that Avago didn't even guide down the most recent quarter. I think they guided down the quarter before, but they didn't guide down this quarter. Cirrus Logic had a massive guide down. And everybody said, well, maybe they lost content in the iPhone. Now it doesn't really look like they lost content. It looks like they pretty much were a better predictor of Apple iPhone sales than Apple itself. So I don't know. I'm kind of thinking that the Apple suppliers actually had a much better read on this than Apple itself, because just so you know, the Apple guide down that they just released last night was literally within 0.2% of Skyworks guide down. So which was weeks and weeks earlier. So I don't know. I think the chip suppliers basically were pretty much on the ball, and so I think Apple just kind of ended up seeing this stuff 6 weeks later, honestly. And it's interesting if you look at when Avago reported versus when most of the other Apple suppliers reported, it was about 6 weeks later. And so where the prior report, had prior sales in it. Again, Avago didn't guide it, so it could be possible that Apple's already worked through a lot of their inventory. So we'll see. Well, again, I'm just reading tea leaves. You never know. But I put it this way: I would be definitely surprised if the guide downs out of companies like Skyworks and Micron and Cirrus were worse than they've already released. I'd be very shocked. I think they've released the worst of their guide downs already. So they might have further guide downs or further misses or things, but I think they'll be relatively minor versus what they already reported.
All right, so before we get into listener questions, why don't you give me your sense of where the market is in terms of your own particular technical and sentiment data and where we go from here?
Well, we hit when you were gone, we hit a major sentiment low. I published some stuff. I put at least one chart in the system, if not more. We basically hit sentiment numbers in late December that literally we hadn't seen since 2008. So now again, we haven't had near the correction that we did in 2008, but we had the sentiment fear, and the sentiment gauges hit levels, whether it's new low, new highs, whether it's the percent of stocks below the 200-day moving average. We kind of cleared the decks on all that stuff. Right now, you could almost say that this recent sell-off it could almost be, again, one of these short-term sentiment overbought sell-offs. Now, again, you got hard news with Apple and things like that, but sentiment healed up an awful lot in roughly 5 trading days. I think the bottom, wasn't it it was the day before Christmas. So the day before Christmas was like the puke fest, and that's when kind of all the sentiment matched. Whether it's again, a lot of guys like posted 20 sentiment gauges. It's like, look, once you get sentiment that bombed out that equals 2008, you don't need to keep posting 20 different charts. You kind of get the picture. So sentiment is still pretty low, though. I mean, you still have a huge percent of stocks below 50, 150, 200-day moving averages. You have put-call ratios are pretty elevated still. There's still quite a bit of fear out there. I mean, what are we? Here's the phase we're in now. The phase we're in now is that, okay, unlike me, who had been calling for a correction multiple times this year and had been saying avoid NVDA and avoid FANG and avoid Apple and blah, 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 in July, August, September, if not earlier, well, now you're getting people that are jumping on, kind of piling on and saying, okay, now it's a bear market. Okay, now you got to sell. Oh, man, things are going way lower. It's like, well, guys, where were you? So in other words, once stocks go down 30, 40, 50, 55% off of highs, I'm not really that worried about like finding my next short. I'm more worried about, okay, do I tactically slowly deploy cash, which I've been doing, or do I get really aggressive? Is this the point to get really aggressive? I don't think we're at the point to get really aggressive yet. I think the better point to get aggressive would be something like, let's say we have more bad news this quarter. Again, by the way, my view on this quarter, I think it's going to be a lot like the last couple quarters. We saw pre-announcements the last couple quarters. We saw earnings misses. We saw guide downs. I think the numbers will be relatively the same. I think a lot of the companies that had really good reports last quarter will be somewhat similar companies that have good reports again this quarter. Maybe everybody kind of uses the weakness to maybe not guide as high. Because it's kind of dumb to guide aggressively when everything's everything's negative. So you might as well use that opportunity to not guide as well. But at the same time, I just don't know. I don't agree I could be wrong about this, but I don't know if that just because Apple guided down, I don't know if that creates a flood of guide downs. And so my view on the market would be, again, so here's the best way to say it. There's always a lot of people who say, God, if I could, man, I'd love to buy XYZ stock 30 or 40 or 50% cheaper. Oh, man, if I could just get, Apple at 150 instead of 200, man, I'd load the boat. I'm not saying you should do that. I'm just saying that people say stuff like that. And then what happens is, and I saw this in 2016, I saw this in 14, I saw this in 11, I saw this in 08. What happens is when those prices are in their face, what do? they say, oh, we're going way low. So I don't know. What I would say is have a process, have a discipline, have levels, respect your prior views, because your prior views were probably made more out of logic than out of emotion and fear. And if you can rationally value things, and if you thought that, for example, if you thought when Skywarps was 90 that you'd love to buy it at 60, well, it's at 62. Maybe it's not a bad spot to buy some, right? So that's kind of what I would. That's where I am on the market. I would say, you know, I think we're getting to the point where I think the risks are much better balanced now. I think the risk of something calamitous happening, guess what, is lower, because we've already had a calamitous thing. I mean, by the way, I put this together for the show. I had some of this, but I'll let you guess what the average FANG stock has declined by. Now, this is 6-letter FANG. This is Facebook, Apple, Amazon, Netflix, NVDA, Google. So Jim, tell me what the average FANG stock has declined off of highs.
Off of highs.
Those 6 stocks. Yep.
How about 30%?
41.
Okay.
41. So there you go. Okay, it's not quite cut in half, but you know, you asked me a lot of times this year, hey, where would I be interested in some of these stocks? I'm like, well, you cut them in half, and you know, I think I think I heard people in the background laughing. Well, I mean, maybe they haven't been cut in half, but they're 40%. I mean, you're getting there. By the way, the best one is Google. It's only down about 24%. And, you know, that's probably the best valued one, right? Google didn't go into a bubble. Not really, anyway, not to the extent the other names did. So anyway, I don't know. I'm a lot more constructive. I mean, this is kind of what I've been waiting for. This is what I've been calling for. I did say that the next major move would be higher. That kind of doesn't look like a great call, although within 5 days of me saying that, we did bounce 10%. And then we went down to a lower low. But I don't know, that's kind of I haven't really changed that view. I think that, you know, the time to be worried about FANG isn't after a 41% decline. Now, hey, could all these guys end up going down to 45 or to 48 or to 50 or 55? I guess they could. But is there really that much juice left at that point? There's not. So, you know what? I literally, when you were gone, by the way, I covered all my shorts. Between Christmas Eve and the day after Christmas, I covered all my shorts. Those 2 days, I covered all my shorts. So I'm shortless right now. I don't necessarily like being shortless, by the way. I kind of would still prefer to have some short. They wouldn't be in any of these names, though. I would not. Maybe the one name I think could go down more, and we've talked about this, is NVIDIA. Just because I don't think NVIDIA is even worth what it's trading for right now. I think NVIDIA is probably worth about more like $80, and we've talked about that. But it doesn't feel like a good short here. It feels like I'd be like really, really like hoping that I'm right on my $70, $80 call. And again, I think I'm pretty right on it. But what if it takes 18 months to get there too? That's not a ton of juice if it takes 18 months to get there. I think there's way more juice in tons of names that are better longs. So, and that's how I look at things. I'm like, look, okay, where can I deploy my capital, and where can I get the next 15, 20, 30, or 200% payoff? Is it shorts now? And again, yeah, hey, I liked as many shorts as anybody in August. I don't really like that many shorts now. So not saying shorts can't work. I just don't think the risk reward sets up nearly as good. So that's where I am. You know, there's all sorts of reasons, but here's the 2 easy ones. And then China trade isn't one of them. I think the Fed is kind of going, oh crap now. I think the Fed is, and by the way, one of the reasons I think this could be like 1998. Is because in 1998, the Fed did the exact same thing. Greenspan was way too aggressive. He raised rates way too many times. He used economic strength to jam a bunch of rate hikes in, and he just overdid it. And so then, you know, we had a growth scare. We didn't have a recession, by the way. I don't think we're going to go into recession. I don't even think we'll be close to recession, by the way. But we had a growth scare, and growth scares are scary because a growth scare feels just like a recession. And then then what did he do? So he should have just probably said, okay, I'm not going to raise anymore. But Greenspan completely turned tail and he cut rates. And he eased. I think he cut rates and then eased quite a bit. And I can't remember how. I should know that, but I don't remember how much he eased. But that almost feels like what the Fed might kind of go to. And if the Fed goes from hiking to not just stopping, the Fed should just stop. The Fed should just stop and just not change rates for like 2 years. That would probably be the single best thing they could do, is just do nothing. But they won't do that. So, because they feel like they have to be doing something. So my guess is if they stop cold turkey and there's another month or 2 or 3 of kind of squishy economic data, they might just flat out ease. I don't know if they cut rates, but the easing would probably be with the balance sheet actions. So anyway, we'll see what happens. But that was a huge part of why we ended up with 99, is because the Fed tucked tail. They eased. They shouldn't have eased, but they did. And then they really promoted a bubble. So we'll see what happens. By the way, that would be I would say that's the only hope for the FANG trade as well. If the Fed just stopped in the economy and everything could get kind of normalized, you would see a lot of other stocks become the new leaders and become winners, and I think value would just crush growth and all sorts of things would happen. Maybe energy would really get cooking again. Maybe financials would do really well. But if the Fed goes full, if they start easing, everybody's just going to put the FANG trade back on again. And so that will end up creating this basically the same thing we're seeing right now, but maybe even worse. So we'll see what happens. I mean, we'll just have to react to it as it comes.
All right, ready for some listener questions?
Sure.
All right, so one already asked about NVDA and asked, what do you think about it after this latest drop? I do have the chart.
I think it's going to 80.
Okay.
I think it's going to 80.
All right, quick hitter there. Somebody wants an update on the CLDR and Hortonworks deal.
Well, I think the deal's done as of today. I have been getting a few questions on, okay, well, why is CLDR down $1 or now it's down 86 cents? I mean, first of all, on any given day, and I don't mean to sound annoyed, but and it's not people asking. It's just market action is annoying. I mean, the fact that we don't have an uptick rule is annoying. The fact that we have to deal with the stock selling off on the same news 30 times, it does get annoying. So, but I do think, so I don't know. I mean, first of all, any small cap stock could be down 6 to 8% today. When the Dow's down 500-600 points, any given small cap stock could be down, almost 10%. So I don't think that's in and of itself a big deal. Again, this is one of the reasons I'm not buying LITE. I'd rather stick with and add to CLDR than buy LITE. I think CLDR is better risk reward. I think it's got. I mean, I can easily model CLDR to $25 to $30. I mean, I'm not joking. I mean, and we've talked about at $30, it's a way cheaper stock than Adobe on growth to valuation metrics. I'd have a hard time valuing LITE 3x above where it's trading right now. I mean, that would be 120. I can value LITE to 80, no problem. I have a hard time valuing LITE to 120. I can value CLDR to $30. And again, I don't even have to go to a stretch valuation to value CLDR to $80. Now, does that mean it's going to go there? No, but a lot of stuff that I value stuff to goes there eventually. And sometimes it does it relatively soon. Sometimes it takes a couple years. One time I valued Hortonworks to 22 when it was a $7 stock, and that's kind of exactly where I sold it before I rebought it back. So the bottom line is, these stocks just take a beating. So whether it's Acacia, Cloudera, Documentum. When you were gone, by the way, I added. There are a few new names. Docu was one of the new names added while you were gone. A Docu I didn't like at 66, like it at 40, I'd probably love it at 32 to 35. So kind of, again, small cap, mid cap names are, they're going to have a hard time holding value if, you know, FANG drops 41%. It's just kind of the way it is. But no, I like Cloudera. The deal's done as of today. So yeah, I don't know. Does that have anything to do with the selling? I would almost think that it would kind of be a reason to not sell it, but whatever. I don't know. Maybe there's some risk arbitrage cleanup trades going on today. But yeah, no. I mean, this is if I don't know if I'll do this for you guys. I think the last time I did a stock of the year list, PayPal was in it. A couple other names were in it. I think I did that my first year at Briefing. I don't know if right now I'm more focused on like the next 6 to 8 weeks, frankly, through the Q1 earnings season. But if I had a stock of the year list, Cloudera would be on it for sure.
All right. One listener wants to know, why aren't you willing to differentiate Amazon from the other FANG stocks, calling it innovative and disruptive, unlike the others, which are one-trick ponies?
I don't know if I agree with any of that. I might really like the reader who posted that question, but I don't really know if I agree with that. I mean, first of all, like, I don't agree that Apple is not innovative, and I kind of said that before. I think the criticism that it's not innovative, I could make a case that it could be more innovative. I think Apple's a highly innovative company. I wouldn't say Amazon is the most innovative at all. I think Google's far more innovative than Amazon. What are the other FANG names? Netflix. I guess Netflix doesn't really have to be innovative because they're more of a very specific. They have a very specific mission. But you know, again, innovation many times resides at the very core of the business model. And I would say that one thing that's driven Netflix is how innovative they are with their AI. Their AI, like how you select shows, how you rank shows, how you favorite shows, and then what Netflix does and what they deliver to you and what they suggest to you. They're better at that than anybody. And that's part of the reason that I think the platform has been so successful. So I guess the second part of that question is, first of all, I wouldn't say Amazon's actually the most innovative of the FANG names. And secondly, I kind of think Amazon in many ways is, to me, the least attractive of. I would buy Facebook over Amazon at current prices. I don't like it yet, but I would definitely buy Facebook over Amazon. I'd definitely buy Google long term over Amazon. I think Apple produces way better cash flow. Apple has more. If Apple started doing M&A, they have way more upside than Amazon. So Amazon's kind of, I don't know. It's, if the stock was like 400, I'd really like it. But the stock's not 400. So I don't know. At current prices, Amazon doesn't really excite me a lot. Here's the other thing I think people need to worry about with Amazon. Amazon is probably the most like Microsoft in '99. Thus, it's the most likely, if there were to be a DOJ action, an anti-monopolistic action, again, I'm not saying that because Trump's in office. I actually thought this could have happened under Obama or under a Democratic regime. The same thing could happen. I think Amazon could be the most likely company to be broken up. So I think that's a risk that not too many people are dealing with. And so yeah, I don't know. I don't find Amazon that attractive, frankly. But yeah, I don't think I'd short it here. And there might be a price at probably, I don't know, 1150, 1200, 1250. I might take a kind of a tactical trading long, investment long in it. But yeah, no, again, I don't think it's the most innovative, and I think it's probably in my view, I think it's one of the least attractive FANG stocks on valuation.
All right, another one comes in. Why hasn't Apple settled with Qualcomm, and how will this affect their 5G program? I don't know. I would think it would be very easy for them to settle. I think they probably could have settled at better terms than their existing contract is. I mean, we could basically say, why did Apple violate their contract law? Why does Apple bully all their suppliers as much as they do? That's one of the issues I kind of have with them, by the way. I don't know. We'll see. I honestly don't know.
I don't know. I think they probably should have. You know, why hasn't Apple done more M&A? They do something like, I'd have to go back and look. I used to know all these numbers by heart. I don't know exactly how much cash flow. Let's say they do $60 billion of cash flow a year. I think that's pretty close. Again, forgive me if I'm off by a few billion. You know, why don't they do $40 billion of cash flow in M&A a year? I think that's a better question. So, but yeah, we'll see it play out. I don't think that. I know one thing they're doing is they're kind of tailing the FTC case that is against Qualcomm. So I think we'll just have to see what happens. But yeah, I mean, I favor Qualcomm. Qualcomm's along. I'd much rather be long Qualcomm than Apple. So that's kind of my current view, and that's probably how I'll be. I don't know. I mean, I kind of had the same view on Google over Apple years ago. From 2009-ish, 10. All the way to 2013, I favored Google over Apple. And in 2013, I ended up swapping all my Google into Apple. And, you know, there might be a time, maybe opportunistically, that if I get a huge gain in Qualcomm and Apple keeps kind of underperforming, again, I don't necessarily think it's going to go a lot lower from here. But the stock doesn't go up for 18 months. It'd be a really good buy. And, you know, hey, I'd love to sell Qualcomm 2 to 3x higher than it is right now and buy Apple at current prices in 18 months. That'd be a really good move if it should occur. So we'll see. But yeah, that's a tough question. I mean, there's just some things like that. I think it's impossible. It's impossible to answer unless you basically work for the company.
All right, and I think the last one, I think I've run through them all, is how much lower do you think the market goes from here?
You know, I don't necessarily think the market needs to go a lot lower. I think a lot of stocks, you know, here's the way I would basically answer this too, is that a lot of stocks, I think this gets forgotten, have held November 20 lows. So depending on the stock you're looking at, there's a lot of names that held November 20 lows. You know, the market did go lower. The indices went lower. We've definitely done a lot more damage to some of the FANG names in Apple. So, you know, the lower names like Apple, which represent a big part of the indexes, the harder it is for the market to go lower. So I don't know. We'll see. I mean, I do believe we hit sentiment lows. I think we've hit some tradable lows. You know, I don't worry as much about the indices as other people do, to be honest, and as you know. But you know, I think we're trying to like sniff around a bottom and try to find one, try to hold one. I think a lot's going to depend on what this quarterly earnings season is like. You know, obviously, if we were to have, let's say, earnings misses and guide down by Amazon and Microsoft and Adobe, you know, and 40 other companies, then yeah, the market will probably go lower. But you know, I would point people to a name like a Micron, and that Micron, the last report they had and their guide was horrific. And you know, I remember a lot of people and some folks I commiserate with were like, "Oh my God, this thing's just gonna die." Well, you know, funny thing happened. Micron actually, I think it traded up. It was down pre-market, but I think by the end of the trading day, I think the stock was up. And then you know, Micron hasn't really gone lower since their guide down. You know, I don't really know if Apple goes a lot lower. I think, you know, if you would have asked me where's Apple's low, you know, 8 months ago, I'd have said, oh, you know, that kind of that 125 area kind of feels good. Now that kind of everybody's saying that, I'm not so sure. I'm kind of more thinking 130 to 140 now, 130, 135. So if you just kind of line these up and you say, okay, Apple's getting pretty close. I mean, Google's been like the Rock of Gibraltar. And I don't think Google has much earnings risk. Just like, again, there's a lot of stocks I line up. I don't think they have much earnings risk. You know, Amazon's going to have a whopper. I will say this: if anybody's bullish on Amazon, it's probably a pretty good trade because Amazon's going to have a whopper of a Q1. I mean, you know, their Christmas quarter. So their Q1 report is going to look really good. And you know, they don't really guide anyway. You know, I mean, they kind of put out this soft, hugely has a bunch of standard deviations in it guide. So, you know, the guy doesn't really dictate how the stock trades that much anyway. So yeah, I mean, I think Amazon's going to have a hell of a Christmas season. So, you know, we've probably seen Amazon lows for at least 3, 4, 6 months. I don't know. I will say this. I don't know if Facebook goes much lower. And you remember me talking about Facebook. I think you asked me specifically where where I thought the low on Facebook would be. And I think I said 125 on that name too. Well, it hit it. In fact, it went a little bit below. Facebook actually looks like an inverse head and shoulders pattern right now. I don't love Facebook here, but I think it's, you know, Facebook has kind of done what I think it needed to do. It basically worked off a pretty pronounced bubble condition. And, you know, a 50% decline from a bubble high takes care of a lot of that. And now it's basically in the realm of pretty darn cheap stock. You know, again, you have to kind of model it now on what is the sort of the growth deceleration risk of Facebook, which I don't think, I mean, the analysts haven't modeled that at all. They're kind of assuming, in fact, I'm looking right now, I think the analysts are sort of assuming 26, 27% growth. Well, now it's down to 24.4. So a week ago it was around 26, 27, so they have lowered it a little. You know, that might be a little aggressive. But, you know, if you get a Facebook that's still doing high teens, low 20s growth, with the cash flow production, the EPS production they're doing, I don't really know if it has to go a lot lower. So I don't know. I'm going to say that, hey, anything could happen. The market could go a lot lower. I don't really necessarily think it needs to. I think a lot of stocks basically have printed lows. So I think if it goes lower is much dependent on maybe just a few more key names and if there's something that comes out of left field. But, you know, by the way, I would say this, you know, the market, I think I have this number too. So the 2016 decline was about 20%. On the NASDAQ, we hit 24%. Let me look at the S&P. The S&P in 2016 was 15%. We hit 20. And again, I don't think this is 2008. So I would basically have to be wrong. I think this would have to become morph into a worse than 2011 or something like a 2008. I think for stocks to take, you know, a lot more damage than they've already taken. I think the better question is, okay, what kind of turns them, right? What turns them? What makes them go up? You know, how durable is the up move? You know, I think the biggest risk isn't really that stocks go a lot lower. I think it's that they're tough to trade, meaning that people try to keep buying them as they start looking good. Charts start looking good. You get 3 or 4 or 5 up days in a row, and then so you get the early momentum buyers, and then they get whacked because some bad news comes out. I think that's more it. I think navigating the trading range is probably going to be tougher than worrying if we have another huge leg down. That's probably where I'd put it. And this is a tough market to trade. It's, you know, there's not very many guys like me. By the way, I haven't exactly added a whole lot of stuff. I've just kind of been I've been fairly relaxed because I like what I'm in, and I can hold my stuff 2 or 3 years. So, you know, I haven't really pressed things. I haven't really gotten super aggressive. I haven't pressed margin. You know, I haven't done a lot of the things that a lot of people do that get them in trouble into the sell-off. But I think that it's, again, sometimes it's really more people keep trying to buy the wrong names. People keep trying to buy the FANG names. And honestly, I think that's why people keep struggling. I think if people were looking at different sets of names, different lists, and being a little more judicious in their buying, you know, buying into more panic days instead of buying when things feel good, you know, I don't think they would. I don't think it would be as problematic as it is. In fact, Damon had a good call. He basically said, "Look, I built some positions. I bought some stuff that's cheap." You know, but now I'm gonna see if I can attack gap downs, and that's hard for a lot of people to do because people just prefer to buy stocks when they're going up. I think as long as your mode is you're still buying stocks on the weekdays when they're going down, I think your trading success is going to be a lot better. But you know, I think this quarter will be a good test. I think if we can get through, if I'm right in we don't have, like, the earnings are probably better than people think, then I think that kind of calms things down, and we'll see. But yeah, I mean, I don't buy FANG. I mean, if you're having trouble trading, it's probably not so much the market levels. It's probably more what you're trading. That would be my guess.
All right, and I'm going to wrap it up on this one. One listener asks, have you ever heard of AXTI? I
think I've heard of it, but I don't think I really know them very well. Yeah, I don't know. It doesn't ring a bell. Looks like a penny stock. I don't deal in too many. Although it wasn't a penny stock. I mean, this is, again, by the way, there could be a ton of stocks like this. There could be a ton of stocks that were $10 stocks that are now $4 and $5 stocks. Now this one, I mean, for some reason, I feel like in my brain it wants to ring a bell, but it's not. So yeah, it's kind of escaping me right now. It's probably a semiconductor company if I had to guess, but I don't know it.
All right. I think that pretty much wraps up everything that we could get into today. I think we'll get right back into our normal schedule next week, and we'll have you on at least once, maybe twice. Who knows? We'll see how the market plays out. I know you have a big earnings couple of weeks ahead of you, so we'll let you get prepped for that, and we'll pick your brain on some of the names that you're really looking forward to in the coming discussions that we're going to have. Yeah,
that's in fact my next weekend or two. I mean, that's pretty much it's all earnings prep, and again, we'll see. But you know, that's really kind of what I'm looking at. I'm looking at earnings. I want to see what things are. I want to see kind of what the, you know, where the risk is, and by the way, when I said I kind of expect similar earnings results, you know, there was a lot of the companies that said, look, I wouldn't expect very good results, and they didn't have very good quarters. Likewise, you know, I don't know, I'll just throw out a name like Twitter could have another very good quarter. You know, some of the companies, some of the cloud, even the maligned cloud growth companies, could have very good quarters. So we'll see. But yeah, no, good talking to you. I'm glad you had a good break. You know, I'm sure we all missed you. I hope you did something extraordinarily fun. You know, you'll have to tell me that offline.
Okay. Well, I mean, fun is all relative, right?
hey, I'll just leave it at that. You know?
Right. Yeah, I won't bore anyone with my tales of fun around.
Well, no, did you have a day like where you watched, you know, like 6 Star Wars movies back to back, where I could have made fun of you a lot? You know, you would probably think that was fun. I would think that was torture.
If I really let on as frequent that my frequency of watching Star Wars movies, people would make fun of me constantly. So. We'll just leave the rest to the subject of imagination.
We will. All right, good talking to you.
All right, you too, Sean. Thanks a lot.
All right, later.
All right.